You want to, Kehlani, welcome. Padi, welcome. Thank you so much for joining us. We're going to get started in just a second, but Kehlani, would you please introduce yourself and just briefly tell us who Women in Real Estate is, and then we'll move on to our guest speaker.
Absolutely. I'll keep it brief. First things first, flowers to Sabrina and our whole Chicago chapter for putting together this Zoom series. This is awesome. Women in Real Estate is a movement that started on the social media platform Clubhouse, went viral during the pandemic, and the need for further connection, education, resource sharing was apparent. So myself and my co-founder, Brittany Rose, created the company Women in Real Estate, and now we are able to do the work that needs to be done as far as empowering one another, creating a network. We do everything from events together all across the country. We do deals together, transactions together. We refer deals to each other. So it's this whole movement, a whole network. And as an extension of Women in Real Estate, we have chapters that we have launched across the country. And Sabrina is the chapter leader of our Chicago chapter. So in obviously my efforts and to support the Chicago chapter, I'm here today. And thank you for having me. Thank you for the good work that you're doing, Sabrina. And for everybody that's tapped in here, you will be getting an invite to our upcoming in-person event in Chicago. So please, if you're not following Sabrina on all platforms, please make sure that you do that so you can come to that in-person event. I look forward to actually meeting you all in person, shaking your hands. And yeah, that's a little bit about W.I.R.E.
Thanks, Kehlani. I'm going to need a hug instead of a handshake, by the way.
You know how it is. You know the vibes. You know the vibes. You got it.
Padi, thank you so much for joining us this morning. I would love for you to introduce yourself. We are recording this, so some of the people that couldn't make it today will be able to watch this later on joinwomeninrealestate.com/Chicago. You'll find all the videos. But Padi, thank you so much for taking time out of your busy schedule in order to give us some funding basics that we need in this current market. Please introduce yourself.
Oh, it's my pleasure. Thank you so much, Sabrina. It's nice to really connect with you outside of Clubhouse. I think this is our first time off that platform. But thanks, Kehlani, for creating such an amazing space for women and supporters of women, and Sabrina for inviting me. I've been a mortgage banker for 20 years. I made it to the top 100 women originators in the country. I'm really proud of that. Because I remember a time where I was sitting in a house with no furniture, looking around and wondering what I was going to do to take care of myself and my children. So to have come this far is a real true blessing for me. So I'm excited about talking with you ladies and everyone who's involved today. More importantly, when it comes to real estate in my career, the most important mission that I have is to lower the barrier of entry to home ownership. It's to help people understand how simple it is if you just take care of the fundamentals and make sure that everyone puts forth the effort to get approved. My partnerships with real estate companies across the country, primarily in California, is just based on helping each other grow. So the people that I partner with in my career, the purpose of our relationship is to have a very mutually profitable experience with one another by supporting each other, building up businesses. So I've spent countless amount of time training a lot of agents, providing training, providing education on what's happening in the market, education on loan products, and being able to really help people take their bottom line and increase it by approving people that would have normally not been approved under regular circumstances. So that's my mission. That's who I am. I'm excited to be here with you guys. I have funded about $1 billion worth of real estate transactions. And essentially, I only share that number to let you know that I'm experienced. That's all it means, really. The number just means that I've been doing it long enough and I'm experienced and I'm qualified to answer the questions that you guys have and to go over the basics of funding.
Awesome. Thank you so much for being here. Obviously, she's a plethora of information, so we're going to tap into your brain. I am making you a co-host in case you have anything you want to share on screen. But please, let's learn about kind of the funding basics and what we need to know in this market. And if anybody has questions, feel free to unmic yourself or put them in the chat.
So do we have a bunch of the people who are in our group today? Are they realtors Is everyone in the group realtors or investors? Is that the perspective that we're coming from?
I would say on average, I think everybody's either a real estate broker or non-licensed investor.
Okay, got it. Perfect. Rashida is an investor. Okay, Kalani, how do we share the thing?
I can do it. Do you want me to share from my screen so you can just talk?
Yeah.
I got you. Coming right up.
Hi, Leica. Okay, cool. So essentially, I never prepare anything, and Kalani helps me to be a little bit more professional. So she helped me put together she put together this pretty visual for you guys. So we could just talk about fundamentals. We were talking and we thought, she said, when you think about real estate and you think about the fundamentals or funding basics, what are the first things that pop into your head? And the things that pop into my head are, the fundamentals, right? You have your credit, you have assets, you have your income, you have how much is available to you, your liquid cash to go out and go make a deal happen. So if we're talking about the basic fundamentals of funding, well, we know that the property itself, the asset that you're targeting, is collateral for the loan. And many of you have heard this phrase in real estate that when the deal is good, the money shows up. Everyone knows that. So when the deal is good, the money is going to show up for you. So what is important, and then we've also heard this phrase in life that says when you're prepared, your preparation meets opportunity, that's when success occurs. So how do you get prepared to be able to scout the right project or the right deal so that the funding does show up? And when the funding does show up, are you prepared to execute and create a successful transaction for yourself and everyone involved? So how does that happen? Well, I think that one of the reasons why I put credit at the top of this list is because whether you are an investor or you want to buy a first-time home buyer, or you want to purchase any sort of property, let's say you're a seasoned investor, credit is extremely important. I'm going to explain why. I'll give you one very current example. I'm funding on a property in Georgia. The deal is with a very well-qualified couple. Their properties, all of their residential portfolio is free and clear. They have $1.4 million liquid and available in the bank. They've had a business for a decade. Their income from the business is a $40,000 net on paper a month, okay? So they're super well qualified. And they got an interest rate I locked in at 4.875 on a 30-year fix, yes, in this market. And the reason why they wanted to work with me was because I was responsive. And of course, I had a very competitive interest rate. Then when we went through underwriting, through one of the credit reports and the background checks that were pooled, we found that almost 7 years ago, in October of 2015, they had a short sale on one of their properties. And because of that short sale, that changes their ability to qualify for that really low interest rate, and their interest rate gets bumped up by a whole %. That changes a lot. It changes the monthly payment. It changes their they're being comfortable going into retirement, buying their home of their dreams, their final destination home. And it changes everything. And it's something that you couldn't see by just looking at the credit score. And it's something that you couldn't see by just looking at the credit report, because it wasn't on the credit report. And it it wouldn't reflect on their credit score. So why is that important? Because just like I always refer to it as a pile of laundry, because when I walk into a pile of laundry, I just close the door and walk right out of the room because I just don't want to deal with it. But credit is like that. I think credit is one of those things where sometimes it piles up to the point where we don't want to deal with it. And even the most subtle things that you think won't show up or doesn't show up will come up in the process of purchasing real estate. So that's really important to understand. Another aspect of that creeps up on people is student loans. So for example, if you have a student loan and you decided that you were going to just not pay it, even before this whole deferment thing came to pass, you didn't have to pay it because you just stopped and it was in a delinquent status. Well, you weren't working or whatever the deal is, so it didn't matter, but it stayed there. So let's say it's been 10 years and it's not even on your credit report anymore. They're not letting that go. So it's in a system called CAVERS. It's in a background check that gets pulled up. And if you have a delinquent federal debt, you're not getting any financing. You have to take care of that debt first. And those debts can be taken care of with as little as $5 a month. So I'll answer that in just a second. So credit, it's not even always just what's on the surface level. There are many companies out there that will wipe out everything, including tax liens, from your credit report. But there are other reports involved those things will come to pass. Now, why does it matter? There's always someone that, even if you have blemishes on your credit, that will finance a property because the property itself will cash flow, or the property itself is worthwhile, or because you're willing to put enough money down to mitigate the risk of your credit situation. But here's why it's so important. Because if you didn't have to do that, you could put less down and the cost of the financing would be significantly less. Another example I often state in many of the conversations we have in this space is, if I walked into a store and I bought a bottle of orange juice for $5, are you going to walk into that store and pay $6.50 for the same bottle of orange juice? You're not. You're not willing to walk into Safeway or Lucky's or 7-Eleven or whatever the stores is out your way. You're not going to walk into that store and pay $1.50 more for the same product I bought. But anytime you choose to get creative financing and get creative, you're choosing to spend more money for the same deal someone else got for cheaper, with less down and less cost. That's why credit is the most basic fundamental thing. If you're working on credit, you have to clean it. I would say clean it up first. Nothing makes me cringe. Now, I love the idea of everyone being able to buy a home. I love the idea of everyone being able to buy a home, but nothing makes me cringe more than someone saying that you can buy your first purchase with FHA financing with a 550 credit score and no money down. Because essentially they're telling you you're going to pay $25,000 more in closing costs and fees than I did for the same house. It's called hustling backwards. So if we take a minute to fix the credit and fix our basic fundamental, like foundation. I'm not just going to come drop a roof on a house that has a foundation made of clay that hasn't dried yet. We're not going to do that. So we have to build the foundation of our financial future in the system that we're trying to build it on with our credit. So if you haven't looked at your credit and haven't decided that you want to take your score up 25 points or 50 points or get yourself up over 700, and you want to make that a priority first, and you're willing to make those sacrifices, then investing in home ownership should take a back seat to that. Because I would like to beg you and urge you not to spend more for that same bottle of orange juice that I get to get for $5. I don't want you to pay $7 for the same bottle. That's the most simple way that I can explain the importance of credit. So nothing that you think is hidden under the rug is going to stay under the rug. It all gets exposed through the process. And secondly, whenever you are purchasing this property, everything costs less. Let me give you an example. If you're purchasing a home using conventional financing, I'll give you a real-time example. This is just one off the top of my head. $890,000 purchase in San Francisco. On an FHA loan, the upfront mortgage insurance is $15,000. In the monthly mortgage insurance is $747 a month. That same deal with conventional financing with just 5% down. In both scenarios, we're talking 5% down. The mortgage insurance is $218 a month, and there's no upfront mortgage insurance. Did you hear that difference? $218 versus $747 a month and $15,000 upfront. I tell people all the time that mortgage insurance is the equivalent of taking $200 cash out of your wallet and putting it on and lighting it on fire right now, and throwing it out your window on the freeway. That's what mortgage insurance is. So we do not, and I'm a mortgage professional. I will make money if you call me and do an FHA deal. And I will do FHA financing because I believe it helps if that's the best choice for you. We don't want to deter you from becoming a homeowner. But if you don't understand how it works, then you don't understand that the difference between a 660 credit score and a 700 credit score is the difference between $218 a month versus $747 a month. I can't sleep at night if I don't give you that. So let me just go ahead and address some of the questions. I'll start with the DTI question. Do loans in deferment count against your debt ratio? So if you have a loan that's in deferment, so let's say that Kalani has a $50,000 student loan, And that $50,000 student loan, I have to use 0.5% of that student loan as a payment. So if we take $50,000 and you know, 1% of that is $500. So it's $250 a month that has to be used up against your debt ratio. That's like a car payment. That's going to slow you down. So the way around that is, let's say you had the $50,000, you contact the student loan company, you take it out of deferment and you go into what's called an income-based repayment program. Oftentimes those payments are about 1/3 of what they would be for what we have to use in qualifying you. The student loans are deferred now, but the banking system is designed to qualify you based on what your income is and what your outgoing debts are, and that there's a balance there, right? So we can't assume that just because you owe them money and there's no payment now, that there'll never be a payment. We have to factor that into the equation. But if you have a document that says based on your income, or maybe you have a job in education and then it's going to be forgiven, if you can document that, then it won't be used against your debt ratio. There's many ways to talk about that. That's in residential financing. That does not apply to, and when we're talking residential, for you investors that are on the line, anything that you're purchasing between 1 to 4 units is considered residential financing. So even as an investor, it'll apply to you. I have a client who's putting 25% down on a $1,040,000 triplex in San Francisco right now. And we don't have to hit them with the student loans, and it's still considered residential financing. So anytime you go 1 to 4 units, it's residential. Above that, it becomes commercial. So Marlene is asking that if we, thank you, Rashida. So Marlene is asking, is there a way to pull our own background check and credit report that you spoke about to see what may not be apparent on our credit reports? Not that I know of, because if something is not showing up on your credit report, but you know it's there, right? So it depends on the source. So the background checks that we run in the residential underwriting space, one of them is called CAVERS. I'll put that in the chat. This system is a government, it's for any delinquent government debts, federal debts, I should say. And then there's other background checks. It's just a standard background check. So if you can Google like a fully comprehensive financial background check, then you'll be able to see all the things that an underwriter looks up and sees, anything that's associated with your name. And if someone has a similar name and something's associated, it comes up on these reports, and they want to make sure that that gets addressed. But the main things to be concerned about is any short sales, foreclosures, or delinquent student loan debt that doesn't show up on your immediate credit report. Those are the things that'll come back and bite you. Sorry, can we edit that part out? Me drinking? Okay. All right. So now we have, I started with that because I really want to emphasize the importance of it. It's extremely important that we start with, it's kind of like, like I'm on a journey to do things like I have to finish my office at home, and I have to finish, my garage and whatnot. Last weekend, I finally set aside some time and I dumped 3 15-foot U-Haul trucks worth of stuff that was just sitting in my house. Because until I purified and cleaned the space, what business do I have trying to go and, reorganize or decorate or whatever the house, right? So we got to get rid of the things that are not serving us anymore and create space for this abundance that you want to create through a real estate portfolio. That starts with credit. So let's clean our spaces and make the room for that. If you have outstanding debts and things that you haven't addressed, and then you own a home, they will be quick to attach a lien to that property as well. So we got to take care of the fundamental basics first. The foundation of our financial future is our credit. Now, many people will argue that credit is bullshit. The credit system is bullshit. We don't need credit. So people will say, I have $1.5 million worth of real estate, or $10 million worth of real estate. When I pay off a mortgage, my credit score goes down. This is stupid. I'm like, yeah, because it's called the credit system. So if you're not using the credit system and you're not leveraging debt, then your scores are going to go down, because it's not scoring you on your ability to be debt free. It's scoring you on your ability to manage debt. Why is that important? Because if I own a property that's worth $500,000 and I take out $100,000 from that property, that's tax-free money because it's in the form of leveraging debt. The reason why people want to own real estate and become real estate investors is to avoid paying taxes. And you don't do that through income, you do that through leveraging debt. You can't leverage debt with proper pricing to make it worthwhile if it costs you too much. So you got to clean that up. Okay, I'm done with that. All right, so income. Income is important. Why is income important? So income is important because if you're working on a standard residential loan, a standard residential loan is qualifying your ability to repay the loan. So if your payment is $1,000, I need to know that you make at least $3,000 so that you can pay back the loan, right? Really basic. Now, when you're buying commercial properties, you're buying an investment property, we can use the income that the property produces in your favor. So back to my example, yesterday I locked in a deal at $1,040,000 with 25% down for a triplex in San Francisco. I want you to know that that is a killer price for the city of San Francisco. It's a major equity play. The client's cash flow is $100 a month. They're not doing it for income. They're doing it because it's a massive equity play and it's fully occupied. The building brings in $5,280 a month in rent. And that's the existing rent that has not been increased yet with tenants that have been longstanding and paying on time. His mortgage payment is about $5,100 with 25% down. So if I'm looking at the property's ability to repay the loan, if the payment is $5,200 and if the rent is $5,280 and the payment is $5,100, does that property have the ability to pay for the loan? It does. The property itself is producing income, and I'm adding that to his income, and that as a result, he qualifies for the purchase. So whether it's residential financing or commercial financing, and you're buying an investment property, the income that is produced from the asset is used in your favor. If you are using just your income to qualify and you don't need it in residential financing, that's fine. When you're buying let's say a 5-unit, 10-unit, 15-unit apartment complex, and those are the properties that you're getting, we're strictly looking at the property's ability to repay the loan. Your tax returns are a basic function of saying, hey, we're documenting who you are, we're documenting that you actually have a business, that you actually are employed, but we're not using your income in this equation. It doesn't matter, because if you stop paying on this loan and we default, we're coming for the property. We're not coming for you, because I can list the property for sale and I can make my money back. I'm not going to chase you down, right? And that's another term that you might want to get familiar with is non-recourse lending. When you're buying properties in the commercial space under a corporate entity and you're not personally guaranteeing it, they don't have anything but the property to come after. So the income that's generated for your approval for commercial properties is generated from the building. And also your income can be coupled with income generated from a multi-unit property in the residential space. And when we say multi-unit in residential, we're talking about 2 to 4 units. Multi-unit in the commercial space is anything higher than that. Okay. So, and also, even if you're buying a single family residence, but you're buying it as an investment, we can still use the income, the market rent from that property in your favor. So the market rent that's coming from the single family home. So just this morning, I wrote an offer on a for $415,000 in Oakland, California. The property's worth about $550,000. It has a tenant in there paying $2,600 a month. So my mortgage payment on that will be $2,300. So I'm buying it because in California, it's more of an equity play. It's not huge, but the rental income on that single family residence is going to cover the mortgage payment for me on that house, on that investment property. So my income on top of that will qualify. So income is either coming from you or coming from the property. And in some cases, you can couple both of those things together. Okay. What type of deal qualifies? Good question, Marlene. I purchased 5 properties in Kentucky. They were all single family homes. It was 4 properties total, but one of them had 2 homes on one lot. So it was 5 total, but for 4 addresses. I purchased them with 25% down using a non-recourse loan strictly under my business. And that was just a basic single family residence type of purchase, but it was one seller. So it's considered a portfolio loan. So any deal that you want to buy under your business entity will qualify for a non-recourse loan. A non-recourse loan essentially means that you as a person, so Marlene, your person is not co-signing for your business, is essentially what it means. And so as long as you have your business is established and your business can show earnings, you should have no problem getting a non-recourse loan. And of course, a good history. So I've developed those relationships with certain lenders. I can get hard money on a deal for myself within 7 days with no appraisal. I can get those non-recourse loans on portfolios really quickly for single family residences because that's the space I've been playing in. So non-recourse loans will qualify as long as your business income is established and your business entity is established and you qualify. So hopefully that answers your question. Assets matter because of a simple word called reserves. Okay. So reserves is the amount of money that you have left over after the down payment and closing costs. So why does that matter? Because there's something called an occupancy factor. So even in residential financing, we're assuming that at least 25% of the time, your property may not be occupied or generating income. This is a risk mitigation calculation that's done. So we're basically saying, hey guys, everything ain't peachy 100% of the time. 75% of the time it's going to look good, 25% it might not. So you have to have money in the bank that shows me that if you had a downturn or something went wrong, that you have what it takes to cover the cost of operating this property. Now, with residential financing as first-time home buyers with conventional loans and FHA loans, reserves are not required. But when you get into higher price points or multiple properties or investment properties, they do. Commercial financing, they do. It matters. You have to have money in the bank. So let's say that from a strategy perspective, Kalani and I are sisters. Kalani, Sabrina, and I are sisters. So we create an entity that we all own equally. And we decide that we're going to save money into that bank account because we want to be able to show reserves. So let's say that us three sisters decide that we want to make sure that anytime we need to show reserves on any deal, that we can show that bank account. So we would all put our savings in there and it would all be, legally drawn out and whatnot. And then that's just money that we tuck. So now instead of one person saving money, we got 3 people saving money and that money stacks up faster and the reserves look better. If you're doing it on your own, you can use your 401k, you can use IRAs, you can use stock accounts, your Robinhood, your crypto. You can use everything you want for reserves, but you got to have them. So you have to have your checking account, you have to have your savings account, and then, whatever else you might be tucking aside. Like I do this little savings account for vacations where I just put X amount of dollars away every single month. So I know that that's the money I can blow on a vacation. And then I have my reserve account, and then I have, stock account. So you're going to make sure that the way that you're organizing your assets, you always have an account that doesn't have too much activity with a good amount of savings in it. Jennifer, do you have to have a personal guarantee for a non-recourse loan? So the nature of a non-recourse loan is that it does not have a personal guarantor. That's what makes it non-recourse. So the short answer is no. But that's when the business is established and well qualified, going for a non-recourse loan, the interest rates will sometimes be higher than what you can get, and the down payment requirements are lower. So there's a balance, but it depends on how well established the business is and how well qualified the business is. Typically, people will guarantee the loan, but there's many reasons why we don't want to do that. One is with residential financing. So standard conventional loans are the cheapest way to buy and build your investment portfolio. That's under your person. So Jennifer Bell, Padi Goodspeed, Kalani Blackwell, under our person using conventional financing is the cheapest way to get long-term loans for investment purposes. You can do up to 10 under that structure. Once you get outside of 10 standard conventional mortgages, that's when you have to step out and do non-recourse loans. And that's when you have to step out and do loans under your business. Nobody who can qualify for standard conventional financing will start with non-recourse loans unless there's a reason for it. And there's various reasons, because that financing is more expensive. So once you've reached the 10 mortgage loan threshold under your person, that's when you step out and do financing under your entities. And I'm talking strictly residential space. If you're buying multifamilies or anything with 5 or more units, then you definitely need to have your your financing that's done under an entity, whether you personally guarantee it or not. Hopefully that helps. So the collateral is what we kind of been talking about in all of these steps. It does matter. The collateral is the property. So I think I remember when my friends recommended that I go into the mortgage industry based on this one badass broker that I met. And she was like, you've got it, you got to do this. I was like 19 or something. And I remember I didn't understand what a mortgage meant. I didn't understand that there was a deed, and that deed would determine who the owner was, and that a mortgage was attached to that deed. And I never forget how ignorant I was to that to this day. I didn't understand what that meant. So I like to emphasize the collateral piece, because collateral is essentially, if Sabrina asked me if she could borrow $5,000, I'm going to say, can you give me your necklace? Because I'm going to hold on to your necklace. That necklace looks pretty and expensive. I'm going to hold on to that necklace until you pay me back. That's collateral. So the property, so the reason why you'll often hear that even when you have a loan on a property, you're not actually the owner, is because the bank can take that property if you don't make the payments on it. So that's what collateral is. The building that you're purchasing, the building that you're buying, is what the bank is using as a security. When you have secured debt, it's always cheaper, and it's secured by the collateral, and that's the property. That's why you have extensive appraisals and inspections that take place. So it's important that you know that the property you're buying is also going to be thoroughly evaluated and the bank can make a decision about whether or not they'll give you a loan. Even if you have an 850 credit score with $10 million in the bank, if they don't like the collateral, they're not giving you the loan. So keep that in mind. The collateral is important. And then just finally, wrapping up these thoughts is with the word process. Why is the process important? Because paperwork sucks. You know, paperwork absolutely sucks. So we have people that are super well qualified. Again, lots of money in the bank. Everything looks really, really good and on their bank accounts. Their credit scores are over 800. Everything looks perfect. But guess what? They still have to go through the same process of providing those bank statements and filling out an application. So my suggestion would be for anyone who wants to start out in this process, or needs to, get going on home ownership or buying whatever they're trying to buy, then I would suggest that you start with a personal financial statement. It's something that you can find online for free, like a PDF. You create a personal financial statement, and all of the information that you're putting in the personal financial statement, keep the documentation handy. So if you have a Dropbox and you set up for yourself, this is something that we're actually going to be teaching through an academy that we're building. This is like important information that I'm telling you, people who are worth millions and people who are worth thousands just don't understand alike. So if you can set up we call it the power of two. So if you have 2 most recent pay stubs, 2 most recent bank statements, 2 most recent tax returns, 2 most recent W-2s, your 2 most recent, commission statements, your profit and loss statement for the year, and you keep those up to date and handy in like a Dropbox folder, then the income documentation that you need for any sort of financing transaction is essentially available at your fingertips and ready to go at all times. So the process is always going to involve paperwork. You're at the very least, for the commercial financing, you need bank statements and tax returns and the personal financial statement. The personal financial statement is essentially this document that says, this is who I am, this is what I make, this is what I have, this is what I own. It would be very eye-opening. It's similar to people who use Mint as a method of managing and looking at their finances from a bird's eye view. And when you're looking at it, you're saying, oh, okay, wow, this was my income, this is my debt, this is my net worth. That's a very eye-opening experience for people. So if you take the personal financial statement and you fill it out, and then you keep the documentation. So for example, if you're listing bank statements, like your checking and your savings and your retirement and your stock, well, do I have easy access to those bank statements online? Let me access them and save a couple of them. Now, do I have my tax returns in PDF format readily available for me? Do I have the federal returns? Do I have my business returns? Do I have my profit and loss? Do I have access to my QuickBooks? Let me keep that. On this document for the personal financial statement, I've noted 3 properties that I own. I need the mortgage statements, the tax bill, the insurance bill. And if I can keep those handy, and I have a little password for the logins, and I know where I keep them, and I have all that ready to go, the paperwork process will feel a lot more smooth. There's nothing worse than starting a real estate transaction, being super excited about the numbers, and then having to spend 3 hours tracing down the documentation that's going to be needed. There is, anytime you hear of digital mortgages in the fintech community, the financial technology community, wanting to step in to really revolutionize this space. The reason why they can't do it is because you cannot properly analyze risk by just data points in a computer. You have to read the documentation and see what's coming in and out of a bank account, see what the income trend has been, see what these patterns have been, because we are assessing someone's ability to repay a loan. So that's why the process is important. The process starts with you being organized. Take a personal financial statement, fill it out completely, and make sure that every item that you've listed on there for your income, assets, and credit is easily documented. So you know exactly where to get that information. And I'm telling you, any process for any loan will be really, really easy for you. And that about does it for the basic fundamentals.
Padi, thank you so much. I love reading the comments. Thank you so much for letting us tap into your brain and dropping all that knowledge. Everybody, this is Padi's contact information, so feel free to reach out if you have clients that need a good lender. Here you go. We just handed it to you.
Well, let me really quickly, because Padi won't brag on herself the way that some of us will. She's so humble. Padi she's a top 1% originator nationally. It's a really big deal, especially for a woman in the space. It's a really, really big deal. And she's made herself readily available and easily accessible. So you can book time with her one-on-one by going to bookwithpadi.com, snag some time on her calendar. She lives and breathes and dies by this calendar. So please take some time if you need to meet with her. If you have any questions, that's for yourself, your own personal investment goals, or for clients as well. Please feel free to grab some time with her. If you liked this information, and this was just some kind of really high level fundamental things, you're really going to like the webinar that she does. We actually have one coming up this Thursday. It's a monthly webinar called The Truth Behind the Headlines. And Padi, why don't you tell people what that is?
Yeah, sure. Thank you. So just Talia, I appreciate you saying that. Last night, my last Zoom ended at 9 p.m., whether they're first-time home buyers or investors. I just love getting on and sharing things face to face. One thing that really, really solidifies the relationship between a realtor and the client is when you're able to present solid numbers. So everyone gets caught up in the emotion of buying real estate, the excitement of buying real estate, but the numbers make it so real. And when people get a grasp of how valuable it is to make the investment, and you're the realtor providing that resource, it really, really nails in that relationship. And I've seen it time and time again. So right now, in the state of the economy that we're in, we have a lot of fear and uncertainty, and people just say, hey, I don't know what I'm supposed to be doing. Should I buy a house? Should I not buy a house? The Fed raised the rates. If the Fed raised the rates, what does that mean for me? People don't understand that the Fed raising the rate actually has a positive impact on inflation, which has a positive impact on interest rates. We need to talk about what inflation means, what inflation is doing, how that's impacting the real estate community, what's happening with price stabilization, and we need to figure out why these headlines are created. We need to talk about the headlines that are creating fear. So we'll talk about some of the most relevant reports that have come out by entities like realtor.com, and we'll look at that data. We're going to analyze it, and we're going to talk about real-time information. I can tell you from a lender's perspective that the demand for purchasing, in my opinion, has cooled, but it is not dead. There's no sign of things falling off. Like in March, I had $61 million worth of applications. And in June, I had over 31 million. That's a 50% decrease in applications, but I still closed over about $15 million worth of business. So the people that are applying are highly motivated. They're ready to go. Anyone who's in the market right now is looking for a hot deal. And Talia, I'm licensed personally in 21 states. My company can lend in all 50 states, but I'm personally licensed in Chicago, in Illinois. I'm licensed in many states directly myself. And even if I wasn't licensed in a state you needed financing through, I would be able to manage the transaction myself. And I have team members that are licensed that the loan would go under. Yeah, I've done plenty of loans in New Jersey. I'm also licensed in Maine. So I got you. I got you. Yeah, there's a great deal in Oakland I offered on this morning too. And there's a plot of land that I'm working on too. So I'm actively doing this. I'm actively buying it. I'm actively taking the risks, and I'm actively scared, just like all of you guys, you know, but I'm actively making myself do it. So we got to do it. And that's, so on the webinar, we're going to talk about market, what's happening in the market, what those headlines mean, what people are actually doing. And I've been asked just to spend a few minutes at the end doing Q&A for anyone that has loan structuring questions at the end of that. So I'm gonna start letting people know that if they have deals that they want to structure and they need some Q&A, we can do that on a live platform around a couple other people so that everyone can benefit from it. Why I would like to do that is just give you an example for any realtors in the room. So the reason why we're able to increase the bottom line of our real estate partners by at least 25% is because we find creative ways to get the job done. I have a client in Georgia. She just got into contract for $650,000. Such a sweet lady. Her income on her tax returns is $30,000 a year. But if I analyze her bank statements, she brings in $88,000 a month in revenue after her expenses and her overhead. So I was able to qualify her using 12 months of her most recent business bank statements. This is a game changer. Let me tell you why. So if you are paying taxes on your income as a self-employed person, let's just call it 30%, because across the board, that number is going to vary. So if I took an extra, if Patty said I don't qualify unless I have $100,000 of net income as a self-employed borrower, and I claim that, I'm now paying $30,000 in taxes. If I use my bank statements instead, and I don't claim more income on my tax returns or cut expenses, guess what's going to happen? I'm going to pay a higher interest rate, but it comes out to approximately $16,000 to $18,000 more a year in interest that I have a tax benefit from. Which one's better? Paying $30,000 to the IRS or paying a higher interest rate on the loan using your bank statements? This is a big eye opener, big eye opener. So you don't have to make more money, or you don't have to cut expenses to make your net income higher on your tax returns. You need to understand the math that taking a higher interest rate is actually more beneficial for you in the long run. And we can take self-employed buyers that are denied by banks every single day and get them approved. I have another client who sat with me yesterday. She's going through a divorce. She has a separation agreement that's done for her. She's getting child support, alimony on top of her own pay. She's putting $250,000 down on the home, but her debt to income ratio is up to 50% using jumbo financing. Now, if you know what those terms mean, you mean that when the loan amount exceeds the county loan limit, there's restrictions to the credit scores and debt ratios. Well, we can go to 50%. The average for the industry is 43%. So she still gets to get approved with a 4.875 interest rate with a 50% back end ratio, because I understood what product to put her in. So when others say no, we will find a way. That's how we can increase your bottom line. When a client has been discouraged and defeated, I've had countless women of color that have been denied at banks for loans when they would have been easily qualified otherwise, and we find solutions for them. So we're the ones that are going to listen and find the right products for you guys and find creative solutions, but more importantly, help your clients understand the math behind it and why it makes sense, even though the rate might be higher. So that's what we'll talk about.
Awesome. Any questions?
I see a couple in the chat. Yes, we do Texas and Virginia. Absolutely, Stephanie. I am working on a commercial deal where the seller wants me to assume his loan. However, oh, sorry. Okay. We don't have to talk about that on here. If you guys are going to email back and forth, that's cool.
Mm-hmm.
Sounds good.
Yeah, you do. You have to, but to give you a quick answer. If the loan is assumable, you contact the bank and you go through the process. The bank directly has a process that you go through to find out what their qualifications are. There's no general black and white there. So that's a great deal. You should absolutely go for it. And yes, you would have to cover the difference unless they agreed to do seller financing for the difference, which if I were giving you the option to assume a loan like that, I wouldn't be giving you the option I want that money. So whatever that difference is, come up with the down payment and go and you contact the loan servicer. If you need help with that call, you can send me the mortgage statement from the seller and I'll take a look at the numbers for you. But that's what you do. You have to call the loan servicer, get on the phone with them, with the seller, and ask them what their process is for the assumption. And yes, I would be prepared to pay the difference. And that's a hot deal, especially if it's cash flowing.
Perfect. Stephanie, I will introduce you guys via text as soon as we get off of here. Okay.
I love VA loans, by the way. For all of our veterans, we waive our lender fees. I'm sorry, Kalani. So VA loans are amazing. We love VA loans. We do. I love veterans. I've been at every time on Veterans Day, I see a bunch of realtors posting some shit about veterans. I'm like, you're the same person who would not accept an offer on your deal because they had a VA loan. So I want you to appreciate our veterans by when you see an offer come across your table with a VA loan, you respect it and you honor them and you give them the opportunity to buy it. VA loans are amazing because there's no monthly mortgage insurance, there's no down payment, and if they have any percentage of disability, they don't even have to pay the VA funding fee. And I'm a strong advocate for our veterans. We have a system in place to waive all fees, all lender processing and underwriting fees. And then what we do is make sure that they're in position to place a non-contingent offer with an 18 to 20-day close, which is unheard of for VA. So we put them in position to win, to try to make sure that the seller is just not worried about whether or not they're using VA financing.
Oh my God, I love you. I know, I love her too. Isn't she great? She's so good.
Praise God. We're going to build these communities together. I mean, I care so much about our people, our communities, and lowering the barrier of entry to homeownership for everyone that has to face these, inherent discrimination practices in the industry. I hate it. It drives me crazy. I can't sleep at night sometimes when we're fighting for people to get their offers accepted, even in times like this. But also something super encouraging is, guys, like in the last 5 contracts that have come across my desk, there's been almost $95,000 in seller credits combined. That's crazy. So this is the time. I'm like, listen, if you've been a real estate agent for the last 5 years, you probably don't even know how to write a seller credit into the contract. Okay. You don't even know how that goes because you haven't done it. It was non-existent. But right now the conversations we're having is, what can I offer under list price and how much can I ask for to get my rate bought down or my closing costs covered so I can go in. The deal we put together last night was at 1.125 million. We're asking for $25,000. So they get to buy down their interest rate with 13,000 and get 7,000 towards closing costs. So, I mean, it's a great way. It's a great way to shop and save people money. So if you guys are a buyer's agents, you're working with buyers and you want to put together some of the buyers that were on the fence for the last year and a half, and we can do a Zoom call to get them pumped up and motivated, now's the time to go out and make those deals for your buyers. Buyers were complaining 7-8 years ago, everyone's buying cash. I can't compete with them. 2 years ago, they were complaining, there's too much competition. I can't write the check for the premium. I can't get my offer accepted. Now they're complaining that the interest rates went up. Well, when are you going to stop complaining and get off the fence and make a deal happen? You got to stay in the game. That's what I tell the buyers all the time, family included. You got to stay in the game. So right now, yes, the rate's higher, but the price is stabilized. So you don't have to write a check for the premium to get in. You're almost right there about in the same payments because of the price difference, and you can get some money back for your closing costs. And I can tell you one thing, when the inflation gets under control and the rates go back down, the demand is going to go back up and the prices are going to go back up. So this would be a very good time to encourage our buyers to get out and make the deal.
Mm-hmm. Well, and two, you just dropping the mic. I just want to reinforce one more point, and it sounds kind of cliche, but this is exactly why your team in the business actually matters. Most real estate agents, especially to your point, that got in the game within the last 5 years, can rub 2 pennies together and make money because the market was so hot, and don't actually have the sales skills to required to navigate market conditions like we're seeing today. And so it's really important that we educate ourselves as industry professionals to be able to have these kinds of conversations. Most agents can't speak intelligently to the finance side of things. And I don't think that you're expected to every extent, but you need a Padi on your team that can help people understand, break this all down into layman's terms, make them understand what they're getting into, what's actually happening, what they're seeing in the market right now. And I mean, don't get me, aren't we facing another 75 basis point rate hike like here in the very near future?
Yeah, that's what they say. Now, after this last CPI report, the index went up to 9.1%. I was shocked that night.
Inflation, 9.1% inflation.
Inflation went up to 9.1%. I couldn't sleep that night. I had a client who was a first-time home buyer. Let me tell you, this woman is the first member in her family of 3 generations in the United States that was becoming a homeowner. First. I'm getting chills telling you this. I cried with her on the phone. She's got into contract, and the night of right before this report came out, the inflation. So I was like, oh my God, the next morning, the rates are going to jump so high because of this inflation report. And it's going to just, make her payment go higher. It's going to discourage her. I was just worried, sleepless all night. Well, in the morning, the bond market jumped 44 basis points, which means the cost of rates went up 44 points. But by the afternoon, the news settled and the rates went down another 70 points. We're talking about in the bond market. So when the feds raise the rates and they're tightening the money supply, we are not seeing that translate into the actual mortgage rates going up. When they do that, it instills confidence in the economy that they are going to get the money supply under control and therefore inflation under control. And as a result, the bond market performs well and mortgage rates improve. So we could potentially see another refi boom early next year by Q2 of next year. My prediction is 18 to 24 months before it turns around, depending on what happens with this war and the cost of oil and all these deals that the United States is trying to make with the Arabs. We'll see what happens, okay? But I'm telling you that this environment, the recessions, the downturns never last as long as the upturns. We had 12 years of upswing, 12. So it was time for that correction. The correction is here. These are the times where we say these make you a millionaire. If I knew what I knew today and I had what I had today and I was in 2007, do you know I would be in Italy right now? I would not be on this call. I would have bought up everything I could in 2007 and 8 when it was crashing like crazy. And I would have literally been worth, at least 15 to 20 million. And I'd be in Italy right now. So I'm working on that. So this is a huge opportunity. We have to think of downturns and hardships as opportunities because it then keeps our eyes wide open, our minds clear enough to be able to digest things without the emotion of fear. Fear and doubt are the most destructive seeds that can be planted within us, within our communities, and also within the customers that we serve. So we're going to eliminate fear and doubt by talking about the truth behind the headlines and staying motivated and excited about what's happening in the market.
Yay. All right. Make sure you guys scan that QR code. I'm about to stop sharing. I know you guys all have other meetings. So Sabrina, I will let you take us out. Thank you so much for having us today, me today, Padi today. Good work, Chicago chapter.
Can't wait to meet you guys in person.
Thank you so much for your time, Padi. Thank you,
Sabrina.
everybody.
Bye, ladies and gentlemen.